It's been a good year so far for stocks. It's been an even better year so far for energy stocks. And we're going to talk about that right now on Open Interest. Hello, everybody, and welcome to Open Mic, sponsored by OptionPlay. I am Mike Coe. It has been a great year so far for stocks, as I'm sure many of you will know. It has been a better one for energy stocks. We're going to talk a little bit about that. Crude oil, so if we're talking about Brent, today wasn't the best day overall. I think energy stocks, if we're looking at the energy select sector index, relative to the S&P, that underperformed by about 60 basis points. But overall, it has been outperforming so far this year by about 8%. And this is largely because, among other things, West Texas Intermediate at this point is coming very close to the recent highs that we saw. Brent, not quite as much, and I think we actually have a chart of West Texas Intermediate in here somewhere. By the way, energy stocks are up, I think, about 17% or so year to date. Round numbers, you can see right here that West Texas Intermediate is approaching the highs that they saw last year, and many people are expecting it to exceed them. Brent, which now trades at a premium, it used to be the other way around. West Texas Intermediate used to trade at a premium to Brent many years ago, but that's no longer the case. But Brent is approaching its highs from a year ago, but is well off of its all-time highs, as is West Texas Intermediate for that reason. One other thing that I think is kind of interesting is we might take a look at the crack spread. And the crack spread is basically the difference between the value of the refined product. So they have a gas crack, there's a heat crack, so on. Well, it used to be called the heat crack. Heat and jet, kerosene, all those things are pretty much sort of proxies for one another. They're very much the same product. So heating oil and diesel fuel, for example, are basically the same stuff. One's got a dye in it. It has to do with road taxes and so on. But if you refine a barrel of crude oil, 50% of it turns to gasoline and about 25% to heating oil / diesel, whatever you want to call it. And then, of course, you have the other byproducts like naphtha and kerosene and so on. And what we've seen is that the crack spread has basically maintained a relatively high level. I don't know if we have a chart of the crack spread handy. If we don't, I can probably pull one up. Why do we care about the crack spread? The thing about the crack spread is that when we're thinking about the energy complex, you've probably heard it broken down into three different parts: upstream, midstream, and downstream. So upstream is going to be your exploration and production companies. So for example, that would be Marathon, ticker MRO. And downstream is going to be your refining and marketing companies. That's going to be like Valero or Marathon Petroleum, MPC. And in the middle, you're going to have the midstream companies. Those are the transportation and logistics businesses that transport product. That's going to be companies like Kinder Morgan. And then, of course, you always have the integrated oil companies, and they essentially touch all of these businesses in one form or another. And then, of course, we also have a number of businesses that service various parts of the industry, equipment, oil services, drillers, and so on, depending on which part of the business you're looking at. I was looking specifically today at the downstream business. Companies like Marathon Petroleum, MPC, again, rather than MRO. So that MRO, again, is the upstream, MPC is the downstream, and Valero. And the reason I was looking at these is that even net of this big rally that they've seen, these companies still remain quite cheap. And the other thing is that we're going into sort of peak season for their product, right? So gasoline demand, remember that half of a cracked or refined barrel of crude oil is going to be gasoline. We're going into peak gasoline demand. Now, sometimes you sort of want to buy the rumor and sell the news in this space, but we're not quite to the sell the news, sell in May and go away yet. We are still in the early innings of April. So I think there's potentially still some upside room in this. So we can actually take a look at some trades here. And why don't I just take a look at these two? We'll start with Marathon Petroleum. And, you know, one of the things that's obviously a real challenge to do is to chase winning stocks like these. And so we might look to option strategies as a potential alternative to buying the stock here. And for that, I was thinking about using diagonal calls. I actually wrote about this and published a piece about it over the weekend on CNBC Pro's website. But we're going to go over those exact same things right here now. So if you are not a CNBC Pro subscriber, then you're not going to miss much by watching this now. So when we do a trade like this, what we're looking to do is mitigate the risk of a potential pullback. And what we can see actually is that this stock is obviously, we're looking at Marathon first, and then we're going to look at Valero. Marathon, by the way, is at least on a trailing basis probably the more expensive of these two, but still you're talking about a company that is trading at less than 10 times earnings. So not expensive. Just taking a look here, what I would do then is rather than purchasing the stock and then selling calls against it, which is, you know, sometimes a very nice strategy, covered calls, or a buy right if you don't already own the stock, buying the stock and then selling calls against it, mitigating the risk of a potential pullback by purchasing a longer dated call instead. In this case, I'm looking at the June 74 calls, 74-day to expiration calls. That's the 210s. I would probably go up a strike and maybe go to the first out of the money strike, the 220s, and then looking to sell a nearer dated option against it to collect a little bit of premium. Give yourself, you know, arguably, 20% upside, something like that, 10% upside. Give yourself a little bit of room. Now, the important thing to think about in this case is, are there events upcoming that we're coming into earnings season? So it's definitely something to think about, that many of these companies are going to be reporting, and Marathon is among them. They're expected to report at the end of this month on the 30th, I believe. And so where in relatively quiet periods, I like to use calendar spreads. I'm more likely to use a diagonal when you have an event like this because you want to give yourself some upside. Now, how much upside do you want to give yourself? That's going to depend a little bit on how much the stock that in question tends to move on average around earnings. In the case of Marathon Petroleum, their one-day average earnings move going back the last decade or so is about 3%. But most recently, when they reported, it was January 30th, so they were reporting their Q4 23 results. They reported $3.53 a share, by the way, which was a positive surprise of about 80%. The street was only looking for about 220. Unsurprisingly, the stock rallied pretty sharply out of that, about 6%. And that's one of the reasons why I'm looking at selling a call that gives some upside room, that if this rally continues, you know, the exercise here is to take a long bet. So you want to make sure, if you're going to run through a catalyst that could potentially propel the stock, that you give yourself some upside. And, you know, that's what we're going to be doing here. So buying this basically at the money call, you can extend that a little bit further. And what I will sometimes do, as I've mentioned in the past, is sometimes I will try to capture two earnings with the longer dated option. So in this case, if I'm looking at to June, that doesn't accomplish that. Their next anticipated earnings is actually going to be the first week of August. So if I wanted to make sure that I captured that event as well, then I actually would have to go all the way out to September in that case. Now, the nice thing about going out a little bit longer is that you are not going to see as much of a vol crush in that longer dated option as you will if you buy it going into a single event, because it still has that subsequent earnings to come out. And so while you will see volatility, the implied volatility, the price of options come in a little bit, it's not likely going to come in that much. Whereas the near dated Junes, of course, that could potentially be more of a factor. The downside, of course, is that the outlay of premium is going to be significantly greater. In this case, you're talking about $18 a share. That's not insignificant because that's going to be, I mean, what are we talking about? It's almost a $220 stock, but we'll just call it 217. We're looking at 8.3% of the current stock price. So that does create a little bit of an issue. You will notice, though, that the probability of profit increases just a little bit when you do that. And we'll now do the same exercise in Valero, which is VLO, Victor, Lima, Oscar. So now we're going to do a very similar trade, and I'm just going to double check to see their anticipated earnings dates. So they are expected to report before Marathon. They're going to be reporting on April 25th is the estimated earnings, and then on July 26th is the subsequent. And you'll notice that of the two, this one's also cheaper. It's about 7.4 times. Now, just a quick point I would make as we look at these PE ratios. 7.4 sounds incredibly cheap, and if people bandy around terms like PE ratio, that would seem like a screaming buy. I want to just point out that cyclical businesses will tend to trade at much cheaper multiples because sometimes they're printing money and other times things are not so good. So just bear that in mind, that when you're dealing with cyclicals, PE ratios, while it's helpful, and I do think that these companies are reasonably priced, it isn't the only thing that you should look at. And fundamental relationships like those aren't necessarily the best trading indicator in any case. But like I said, I expect gasoline demand probably to be pretty decent. Sometimes it is better to, in these types of names, and actually we did see this last year too. We did see a little bit of a run up going into the summer, and then it wasn't quite as spectacular thereafter. So if we were trying to capture the two earnings that they're going to have, you're going to try to capture their second earnings result, which is anticipated to be, these are just estimated dates, by the way, July 26th, which means that the July 19th options aren't going to capture it. You'd have to go out to August then and buy something close to the at-the-money option, which is 180. You could actually go up a strike if you wanted to, but we're just going to use the at-the-monies for now. And just assume that you want to sell a strike that's going to be, June would be fine, but I'd actually go probably a little bit sooner. Try to get a little bit of that vol crush out of it. So April 25th, you could sell, let's see, you know what, we better double check because some of these earnings, the estimated earnings have not been accurate. I speculated, if you've watched this live stream before, you know that I have speculated that part of the reason for the confusion on this has been because it is a leap year. And a lot of the algorithms that are used to just sort of estimate when the next earnings is going to be have a tendency to pick the date that it was the preceding year and then just move the year forward. That's fine, except that if it bumps it to very late in the week, so for companies that report after the close, companies don't typically report after the close on Fridays, is a point that I've made. So I've noticed that a lot of the earnings estimated dates this year seem to be getting that one wrong. We've seen a few where they've been forecasting that they were going to report on a Friday. I don't necessarily buy that, but let's just take a quick look at where the options market is implying this is going to take place. And let's see here. So demonstrating that there are no infallible data aggregation services, but so Bloomberg is forecasting the 25th, which would be a Thursday. We know that because the 26th is a weekly options expiration Friday. And what do we have here? So the options market is, yes, okay. The highest implied volatility is actually, until you get out to next year, is in fact on the 26th. So the options market is forecasting that it's going to take place then. This is an interesting case, right? You can, one of the things you can do is just look to shoot against, take that longer dated option and then shoot against it as many times as you can. So In this case, you might say, okay, well, I'm going to buy those 180s, and then maybe I'm going to try to sell the 190s for that week. Right now with the stock 180, that only gives, well, is that enough upside? So what you would be getting in that case, about 5.6% upside. And this thing has typically moved about 2.6, 2.7% on earnings. The best earnings result that we saw, and you don't want to sell upside if you're going to get a really big move, but we haven't had moves much more than 5.5%. We had one back, well, that was 2020. That doesn't count. 2020 doesn't count because we're coming off the pandemic low. But prior to that, you have to go all the way back now to their Q2 2018 earnings results to see an upside move on the, immediately following their earnings where they actually moved more than 5.5%. But if that wasn't quite enough, you could, of course, maybe move up to the 192.5s or 195s and get a trade that looks a little something like this, right? So in this case, buying the August 180 calls and selling the 192.5 calls against it. And then the whole idea here would be that you would just sort of continuously reload. And when I say reload, what I mean is you're holding on to that longer dated call, assuming we don't get, blindsided by some new information that, totally changes the thesis. But the idea would be that once that near dated option expires or loses most of its premium, that you could then go ahead and sell additional premium against it. Okay, so that goes over those trades. So let's just take a look at some questions and see what we see. Okay, so the first one comes from PC. And PC asks, bullish long-term on Google and Citi. So Alphabet and Citi, what are good option trades on them? Okay, so, well, the trade that I was just talking about could be a reasonable trade, sort of what we call the poor man's covered call, owning long-dated calls against it. I, too, by the way, really like Alphabet, it should be said. Now, obviously, we have seen some, in fact, we have a position on it, and I'm just going to take a quick peek and see what that looks like. And actually, it looks like we're basically just on the non-voting shares, which is Goog rather than Google, basically in a buy right there. By the way, as an options trader, just a quick point, we always prefer to be long options premium when we can be. It's just a happier place. It's just a lot easier to sleep at night when we're long premium. The thing is, though, that on a relative basis, even though a lot of these single stock options premiums don't seem that high, on a relative basis, they are really. The relationship between single stock options premiums and index premiums is quite high. A couple of ways that you can calculate this. So, we tend to think of it as implied correlation. And there's a way you can kind of back out that calculation, but I don't want to get too wonky on this. I think it's easy enough probably just to take a look at the ratio between the implied volatility of stocks on an index or any stocks that you're looking at and the S&P. So you can probably get that information from most brokerage platforms. Just get the implied volatility and then just see what the relationship of that is to the implied volatility of the same expiration in index land. And what we're seeing is that in many cases that relationship is quite high. Now, we would expect that index would become more expensive when you start to see some kind of big market disruption. And we did see this. I mean, so since the last live stream, we got this last Thursday. that was a very sharp move that we got after we heard Neil Kashkari's comments. And what's very curious, so this is kind of an interesting, just a side note I want to make, and we'll get to Alphabet in a second, but I found it very interesting that the market sold off as sharply as it did on Neil Kashkari's remarks, talking about the fact that we might not have rate hikes, and that maybe even potentially could see, did I say rate hikes or cuts? We're not going to get rate cuts, but could see rate hikes. And then, since that time, Jamie Dimon has made some comments that were eerily similar to that, making comments that, he suggested that the long rates could go much higher. Maybe we could see rates in the neighborhood of 8%. And basically, the notion there is that the inflationary impact of, among other things, very high fiscal deficits could basically cause inflation to be much stickier than a lot of people are predicting. Now, this is a comment I actually made last week, and again, I'm not going to go too far down this road, but we had an extended period, where we had exceptionally low interest rates. Money was essentially free. And a narrative began to form that people speculated that with very low interest rates, we could essentially print money and there was no inflationary cost to this. And I really take issue with that assessment, because I think many of the people who suggested that such a thing was possible actually didn't grasp what was going on at all. We had a number of deflationary impacts over the course of the last couple of decades that took shape at various times. And I'll go back to the late 1990s as a starting point. Bill Clinton, was often credited with having balanced the budget. Of course, he didn't balance the budget. Congress dictates spending, but at the time, we had basically pay-to-play rules, and there was even talk about, imposing at one point, believe it or not, a balanced budget amendment. But the idea was that they could not introduce new spending without coming up with offsetting tax revenues. And that essentially helped create the environment that caused the budget to be balanced. And I'm going to ignore the unfunded liabilities for the time being in all of that calculation. But that reduces inflationary pressure from the fiscal side. So that was an important element. The other thing was that we had tremendously deflationary impacts from trade with places like China. If you have a huge slew of incoming goods that are coming in at rapidly declining prices, that really offsets inflation. I can remember producer Jay, I can remember when he bought his first flat screen television. It was a 50-inch plasma on sale. I think it was $15,000, down from 20. You can buy a 50-inch flat screen television LED today for probably $400. It's a 98% decrease in the price of that item over the course of 20 years or so. And that was happening in all kinds of areas. And actually, we are seeing it recently now, too. And this is kind of important when it comes to automakers. Look at companies like Tesla. Because they sell their cars directly to consumers, if demand is not sufficient and they see rising inventories, they can impose a unilateral price cut. And they did that just recently. And I think they reduced the price of a Model Y long range by another $4,600. It's now a very reasonably priced car. I think net of the tax credit, you're looking at a car that's in the 30s, maybe. I recently purchased a new car myself. I probably would have bought one of those if I'd known that I could have gotten one so cheaply. I say probably, we already have a Model Y, and I wanted to have a gasoline car too, because we sometimes take longer trips and they're maybe less well suited. So that is an important issue. But my point is that we do have deflationary impacts, and those were often ignored by monetary theorists, such as Stephanie Kelton, for example, who believe that you could just simply print money and then have whatever you wanted. That's not true, never was true, has been disproven many times through human history. And it's possible to believe that if and only if you wear blinders of such a sort that you can't see the deflationary impacts that are all around you. Now, I mentioned the deflationary impacts of the fiscal side because the world that Clinton lived in, where he was running a balanced budget, is very different than the one we live in today, where we have budget deficits that are of a scale and scope that we haven't seen since World War II, basically. And that is inflationary. So even though there has been some runoff on the Fed's balance sheet, I think that is a little bit of a problem. Okay, so leaving that aside, that was a lengthy sidebar. Looking at Google, a company I do like, by the way. I do like it long term. It's a cash flow generator. Some of these companies right now, I mean, whether it's Apple, Microsoft had faced these kinds of concerns before. Obviously, they have some government pressure on them. There's an ad spend issue when you're dealing with Alphabet. But the secular tailwinds are there. They've had some missteps in the AI space. Let's not sugarcoat it. But they are, honestly, they have been, one of the best in the area. I know that people don't think, they often think about machine learning and deep learning. That's become sort of synonymous. Maybe NLP is synonymous with AI these days. But logic inference and search, which is obviously an area where they have tremendous expertise, is also a branch of artificial intelligence. They are big in the cloud space. So they've got a lot of good things going on. Like the company, perfectly happy to own the shares. We own the stock. We are short some premium around it. So I think that's a fine strategy, and one that I would recommend, which is basically just, own the stock and sell calls. But as an alternative, you could do what I was just talking about, which is, poor man's covered call, own long dated premium, and then sell nearer dated against it recurringly. Now, let's just pay quick attention to the earnings calendar here, because this is a situation where this one has had larger moves around earnings, closer to 5% on average. And yeah, so they moved a little over 7% the last time they reported earnings, lower as it happens, and almost 10% the quarter before that, also lower. Becomes a little bit more challenging to sell premium into earnings in those cases, and they're going to be reporting on the 25th. But think about it this way: if you don't necessarily want to be short premium going into earnings, then the opposite would probably be true, which is that you want to own it. Their next earnings is going to be July 25th, so you're probably going to want to own calls that expire beyond that. So that's one thing you could do. Another thing that one can do, if you don't already own a stock and are looking to potentially milk it for a little bit of premium and hoping that you get the opportunity to purchase it at a lower level, is to sell cash covered puts. I think the stock traded down to, what are we looking at here? The mid-low 130s. So, maybe you can look to sell some 140 puts or something like that. That would be another way to potentially play it. But another trade that I tend to like after you've seen a big rally like this, and this is kind of a hybrid because you are selling more premium than you're buying. So astute options traders will say a call spread risk reversal, which is what I'm going to talk about right now, where you buy an upside call spread and you finance it by selling a downside put. That is, that in many ways, that is just also doing the same thing as selling cash covered puts, right? You're short more options than you're long, so you're net short options. You have a capped upside. And actually, let's compare them. I think this is actually a good opportunity to compare these two trades. So let's just take a look at a call spread risk reversal, which would actually capture earnings, maybe going out to June. So just buying an upside call spread, selling a downside put, and trying to finance this thing. We'll look at the 160s. That's the first sort of whole out of the money strike. 160, 180. That certainly gives plenty of upside. And then sell maybe a downside put. Let's see what we can get here. So that one would actually be a credit. We'll get down to there. This one's just about even money. Okay, so buying, in this case, the June 160, 180 call spread and selling the downside 147.5 puts. Pretty close to even money on this trade. So what's the downside here? You end up owning the stock at 147.5. That's about a $9 discount to where the stock is currently trading. So you get to own it at about a 5.7% discount to the downside, and still have about $20 worth of upside, which is reasonably attractive, about 12.7%. So this is sort of, splitting the baby, if you will. Couple of things about this. This line, this curve that you see right here, this is actually how that trade is going to behave in real time. The sort of stepped P&L that you see, that's what that trade is going to look like at expiration. So one of the things you will notice is if you take this further out in time, you can change the break-even characteristics and make them look more attractive, but that comes at a cost, and that cost is that you're going to be dealing with the sort of interim P&L for a longer period. So it's going to sort of act as, we'll call it equity light, right? So it's not exactly going to trade like stock, but it is going to behave a little bit like stock. It doesn't have exactly the same delta. It's not delta 1. Okay, so let's see here. Okay. Hi, Mike. Traveling for a couple of weeks, coming up with spotty ability to manage positions. I'm a single trader. Do you advise just shutting down risk and re-entering upon return to save my sanity? Well, that depends, of course, on the nature of your positions. Most people have kind of a core long equity book, and then are often trading around it. So if that's the case, I assume that for the most part, especially in tax-deferred accounts, people don't usually just day trade out of their equity exposure for that. I will say I'm never enamored of leaving naked short options positions out there. So if you are short options, that's not something I like to leave unattended, especially if there's some margin involved. So I'll often cover those. And I think I've said this before, but if I haven't, I'll just reiterate it. I always am looking to close short options when their yield is not consistent with equity-like risk. Selling options, you are selling insurance on equities. Equities, if you assume that they're going to return 10, 12% a year, no, that's not the long-term average, but that is the recent average. If they're not yielding a number like that, that's definitely the kind of option that I would look to close before I left for any length of time. And I should actually say that every day, one of the very first things I do is I look for every cheap option and look to cover it and redeploy capital. And oftentimes, the first 30 minutes of the day is spent just throwing a couple cheap limits out there, hoping I get to buy some of these back, because sometimes, especially on the weeklies, the option spreads widen out more so than they do on the regulars, and you never know. You'll see a cheap option, 30-cent, 40-cent option. You throw a nickel or a dime bid out there, and it comes back to you. I could probably take a look and see here. Today is a really good example. I bought these, so let's see, 26 cents, 30 cents, 15 cents. Some of them were more expensive options I bought back, but they were on more expensive stocks like Lilly. So, Lilly, I bought some cheap options back. Those were $1.56. It looks like I paid for some of these things, $1.15 for some others. But that's an $800 stock, right? So just as a function of how much the stock is, that was not yielding. And I redeployed, by the way. I think, or I meant to. We may have been working some orders. I don't know if we got it off. We did. Okay. Yeah. Rolled out to the 19th. But I think that's really important. for your sanity and just in general. So whether you're going away or not going away, cover the short side. On the long side, you could always leave a GTC out there. That's something else you can do, is leave good till cancel orders. It's not something I'm usually that much in favor of, but if you have exposure and you really have some conviction about something and you're just afraid that you're not going to be around to take the profits if you get there, GTC order might do it. I hope that helps. Okay, so let's see here. IWM gonna break 207 this weekend. I mean, by this coming weekend? Kind of looks that way, huh? So, yeah, I mean, I'm assuming by this weekend is what David's referring to. I mean, we did get above that level recently, but the market does feel like it's trying to chug a little higher here. I made this point, and I think I brought it up on an earlier live stream. We are in a very sort of steep and uncorrected market. Valuations are high. I think there is a risk on this rate cutting thing. So for those reasons, I'm concerned. But I did point out on an earlier stream that the move that we've seen, I was going back in history and trying to see when's the last time we saw something that looks like this. Let's take a good look at this for a second. I mean, this is a really remarkable period that we've had recently. And, you know, for us to make these kinds of moves without some kind of a pullback, we're up 26% now in 109 days. This is quite a remarkable pace. And actually, as of last week, it was even steeper. Here's the interesting thing. Have I found other circumstances in history where we've had rallies this sharp in such a short period? Yes. Some of them, including the bounce we got off of the pandemic low, I wouldn't count because, you know, when you have something like that it would be like counting the bounce off of the flash crash. I don't really include that. But there was a period that was quite remarkably similar going into the tech wreck. But what was interesting was the closest mirror I could find, absent a pandemic plunge V-shaped bounce back, was going through the end of March of this year, was going through the end of March in 1999. And the interesting thing is that a lot of people recognized we were in a bubble. A lot of people recognized that shares were likely to pull back, but they didn't. They didn't for a full year. That rally continued for another year. So I think it's important to remember that two things can be true at the same time. They can be that stocks are steep and uncorrected, and a correction will happen, or worse, a bear market. But that doesn't have to be pending anytime soon. People were partying like it was 1999, all of 1999 effectively. And for a good period ahead of that, Alan Greenspan was talking about irrational exuberance, I think it was in 96. And that didn't do anything to slow down equities for quite some time. So whenever I express skepticism about equities, I want that context to be very, very clear. That even if I think that we're probably due, that doesn't mean that I think we're due tomorrow or next week or next month. I have no specific insights on that, to be clear. I do think valuations are stretched. I do think we're probably going to get a fairly sharp pullback, but it wouldn't surprise me to see things continue for a while yet. Now, why is that? One of the principal reasons this is true is that we have fewer stocks to invest in now than we once did. And employment is high. Unemployment is very low. And every single time people get a paycheck, some of that paycheck comes out and gets dumped into 401ks and things like that. The money's got to go somewhere. And where it goes, for the most part, is into equities. So the money flow is generally going in, not coming out. And I think that's something that people ignore because we have a tendency to, especially those of us who trade, we tend to ignore the fact that on the whole, money goes into equities. And you need some pretty big shakeups for that flow to reverse. So the general course of things, and then of course you just have inflationary impact. So, and you also have the fact that companies grow. So, the economy grows, S&P earnings grows faster than the economy by and large. Every time there's a paycheck, people put money into stocks. So when you add all of these things together, the general course is that stocks should rise. And the general course of stocks is that they do rise. Over the average 30 days, the S&P rises about 60 basis points. And so that should be our expectation. Our operating assumption should be that more often than not, stocks will be higher. And, that you're looking at probably 60 bips worth of appreciation, all else equal, for all of those reasons. Okay. All right. Oops. Let me see what I have here. S-Browser Sync, do you consider theta decay in the legs you select? Yeah, 100%. Sure. It's actually, theta is one of the, on a leg-by-leg basis, let me see if I can find a good example of this. I'm going to try to pull something up here. Bear with me. So in terms of premium, where did I put what I was working on today? So what I like to look at, and hopefully I can find, so we run these things every day. On the short side, I am looking to maximize the amount of theta I'm going to collect on the short side relative to the capital required to put the trade on. And we do that calculation. We batch run securities each day. And I thought I had kept that batch alive somewhere so that not so I could show it necessarily, but I thought it might be illustrative. That's not what I want. Let me see if I can find this somewhere. You know what? I'll get back to that because I'm not sure if I can find it. But what I was doing basically is a lot of times I'm trying to sell short-dated options and own longer-dated options against it, or own stocks against it, or own index against it, which we do. So I use SPX options to hedge the portfolio. The portfolio is positive theta, so it's collecting premium on average. Right now, it's collecting about, to put some things in perspective, about $4,300 a day. It's net long Vega because the hedges are typically out longer than the premium that's short. We probably have about 40 different stocks in here. By the way, this goes to what I was talking about before. I am looking to collect closer to 26% annualized on the short side. And that is expected theta. So expected theta, what is that? This is, I don't want to get too wonky, and I'll try to get into this if there's an interest, but when you sell premium, there is some probability that you're going to be profitable, and there's some probability that you won't be. So when we're doing things like selling strangles or something like that, we are looking for probabilities of profit that are greater than 70%. Now, for any given stock, there's a distribution for the underlying, and you have, within the strikes that you sell, you get to keep all the money. So let's just say that I sell a strangle, I collect $1,500 for selling that strangle. Well, I can't say that $1,500 is my expected profit. That's my best case profit. That's what I get to keep if the stock does not migrate outside of those strikes. So I also have to calculate the probabilities that it does move outside of those strikes and how much I expect to lose if it does. And what I try to, and then see also how much capital is required to put the position on, which I'm sure your broker will give you. So you can do some of these kinds of calculations and, get to a point where, you're looking to collect maybe 50 basis points a day, 50 basis points a day, 50 basis points a week, relative to the capital that you're deploying into that position, expected. So, that's basically accounting for both the wins and the losses. So absolutely, I care a lot about theta. And I actually that's how I also decide which legs I'm going to close, right? So I don't know what your brokerage platforms will show you, but many will let you actually see the annualized value of the options premium, of the extrinsic value, just as a display. So if you're short options and all of a sudden, it pops up, you can see the amount of premium and then you see how much it is annualized and it's 7%. You say, well, I don't want to be short an option for 7% a year because I'm taking equity-like risk, so to cover that option. But if I can see numbers that are, better than 25% annualized, then that gets to be attractive. And if you start selling on both sides and then you're hedged against your beta, then, on balance, you expect pretty good things to happen. Okay, so hope that helps. Let's see. All right. When do you use trailing stops to maximize profits? I don't put stop orders in, but I'm monitoring these things all day, every day, which I guess is a little bit, most people don't just trade for a living. So it's just something I'm just scanning it constantly. And I will also say, it's interesting. I sometimes will close positions just simply because there's something new that has been introduced and I just don't like the dynamic. We had, I'll give you examples, actually, good examples. We had, and still do, positions in Baba, positions in Baidu. I closed the Baidu position, positions in First Solar. Now, what do these things have to do with each other? Obviously, Baidu and Baba are both Chinese companies, so they clearly would seem to have that much in common. First Solar is not a Chinese company, but Janet Yellen just came back from a trip to China, and the big thing that she was talking about today was that they wanted China to revisit their grand economic policies, that we weren't going to tolerate Chinese companies dumping their products on U.S. markets, particularly where it would disrupt our green economy. And so what happened today? Well, Baidu and Baba, got hit, and First Solar took off because, First Solar is a net beneficiary if the U.S. government decides that we're not going to allow Chinese companies to dump solar panels here. And, I was looking at these things thinking, this just seems like the kind of environment where these kinds of announcements can cause these things to whipsaw in unexpected ways, and I just don't like it. Plus, the charts in these Chinese stocks just look terrible. Put those two things together. It wasn't even a stop. I mean, it was a little bit of a stop, but Baidu pulled back, and I just said, you know what? I have no interest. I'm just gonna take first loss, best loss. Had a position that we had just initiated last week, and I said, you know what? I don't want anything to do with this. I don't need to. I've got enough things to worry about without having somebody, come out and start whining and start beating stocks up for. And I'm not going to say not fundamental reasons. Those are fundamental reasons, but it's just not something I wanted to deal with. But I don't leave stop orders out there, especially stop market orders. You don't want to, you don't want to be the victim when someone runs the stops. That's the wrong side of that. Stop limit orders, especially if you're not in front of your screens all day. Yeah. Hi, Mike. Is it too late to do the Newmont setup you showed us? Update the strikes. Yeah, I mean, look, it's when did we talk about that? Was it Wednesday, I think? I don't know, maybe somebody can remind me. Did I talk about that last Monday or last Wednesday? No, I don't think it is. And if you didn't want to use Newmont, you could use GDX, which is the gold miners. That dynamic, I think, is still with us. Just bear this in mind, though. If rates spike, that's probably not going to be a great day for gold. It's not going to be a great day for gold miners. So just bear that in mind. But if people are expecting rates to come in, if rates soften, and we still have inflationary effects and things like that, then the gold trade remains intact. Look, we broke out. We got those fresh all-time highs. It's a trade I'm in long. Actually, just long GLD in my PA as it happens. Oh, you know what? I'm sorry. You know what? PC had also asked about Citi, and I talked about Alphabet. I don't think I got to Citi. An important point there, of course, is that we are coming right into earnings season, and the financials lead the way, right? So this is kind of a timely situation that we're dealing with here. And what is interesting is that the financials don't typically move that much on earnings. And consequently, options don't typically imply that they will either. The thing is, we've had such a big move already. Citi, I think, since the October lows is up at least 50%, maybe more off those lows. What is that? Let's find out what that is. Well, I'm going to put Citi up over here, and then I'm going to put Citi up over here. Let's see what this move is. Yeah, that's well more than 50. The stock was sub 40, so what are we looking at here? 61% off of the October lows. What are we looking at in terms of price to book? Oops. One important point actually when we're looking at these money center banks, because you might be tempted to think that one's as good as another. They're not really. It gets so tiresome to even say so. JP Morgan, I think, is clearly the best managed of them. It's priced for it too. But, Bank of America, they took on way too much duration. And if, it was Jamie Dimon who, by the way, was the one who was commenting that he thought rates could go higher. If rates went higher, you don't want to book with duration. So bank is one of the ones I would avoid. But what is interesting here is that options premiums are not that high. So, if you had the stock, you wanted to take some profits, buy calls instead, going into earnings, that's okay. We've had a couple instances here where Citi has actually moved. July 22, when they were reporting their Q2 22 earnings, they reported a big beat. I think they nearly doubled the street estimate. Stock rallied 13% out of that. But options premiums are not that high. Let's just take a quick peek at that and see what you're looking at. Not very expensive. You could buy it in the money call spread, maybe the 60, 65, 67 and a half, something like this. Costs less than $3. It's already $1.73 in the money. I think that would be a way to play Citi if you wanted to press that one on the long side. I was actually taking a look at, it's not a money center bank. I was also looking at KKR earlier today. They, by the way, are having an investor day. I think it's 2 days from now. So that's another one to think about that I kind of like. Let's see what else we got here. Okay, does the liquidity of an option depend mostly on the liquidity of the underlying stock? What is a liquid stock? A million shares traded. Daily, something else. Do you avoid illiquid stocks and options? I do avoid illiquid stocks and options. I think from a retail perspective, it's probably less important to worry about it, but you should be cognizant. It's not the number of shares, it's the notional value of the shares that trade that matters. You know, a million shares, you know, there are stocks out there. Look at a crappy stock like ChargePoint. Whatever, $1.80. I didn't even look at it today, but you know, it's sub $2 a share. So that's trading less than 2 million shares. And then you could have a stock like Berkshire Hathaway A shares. And those things don't trade much at all, but they don't need to because it's a six-figure stock. You know, Broadcom. All right, so there's it does trade a lot as well. It trades over 1 million shares. But when you take a look at its notional value, it's trading a ton because it's a $1,350 stock. Booking, formerly known as Priceline, that's another one. You know, that traded 164,000 shares today. Does that mean it's an illiquid stock? Well, not necessarily. It's 164,000 shares, actually 164,534, and it's a $3,600 stock. So that's trading $592 million worth. I would consider that very liquid. You can move a lot of money into and out of it. And actually, we do frequently trade, you know, the options on names like Broadcom and Booking and maybe Nvidia and things like that, simply because the stocks themselves are quite expensive, and you know, it's just as easy to trade a handful of options and move a lot around notionally that way. So hope that helps. What else do we have here? Hi, Mike. Are there certain IV characteristics, implied volatility characteristics, you screen for, formally or mentally, for underlyings? Example for this, implied volatility greater than historical volatility. Well, yeah, of course that matters. But context matters a lot there too, right? So if a company just reported earnings, it is not uncommon to see implied volatility below their recent historical volatility because you get a big event. Let me see if I can come up with a good example of something like that. Just see if I'll find any example. Doesn't really matter. Okay, here's one. So here we're just looking at Apple. Why not? It's one of the most actively traded names. So orange in this case is historical and white is the implied. And you get these bumps. So these bumps like right here and right here and right here and right here. What's going on? That's when news is coming out, and that's most often around earnings. And so it would be tempting, and this, by the way, down here is a chart of the difference between the two. It would be tempting to think, well, if historical volatility is below implied volatility, then it's a better sale, and if it's above, then it's a better buy. The issue is that you need to have some context. So you need to know when events are coming up that could move a stock. Are you selling options premium that looks expensive right ahead of the Worldwide Developers Conference for Apple, which actually doesn't move the stock as much as it used to, or a new product release like an iPhone or something like that? Or are you buying implied volatility because it looks cheap relative to historic coming out of an event like that, when in fact, normally you're going to get this situation. So you can see that for most of the time, selling implied volatility in Apple has been a fine choice, except for these rare instances, and those are almost always around events. And what's also interesting here, and this is 90-day implied, it's probably better to look at something a little shorter dated because the vol of vol will be higher. But even there, sometimes it's not high enough. What this does reveal, though, is that why I often say I don't like to be short a ton of premium going into earnings. And that's because that's when stocks really tend to move, and oftentimes more than people think they will. And they think they're getting a juicy premium, and that's okay if you own something else against it, which is why we like things like these diagonals and calendars, particularly if it's a multi-event, long-dated option that captures those types of things. But yeah, so I care about where implied volatility is relative to its historical context. So, is it higher or lower than it has been historically? That matters to me a bit. So some people will think about implied volatility percentile, but it's one factor. The very first thing I do when I'm looking at trading options on something where I don't have a position is look at the event calendar. Do they have an investor day coming up? Is there a roadshow going on? Do they have earnings? All of those things matter. Big economic releases, especially for those companies that are going to be more sensitive to them. That's the biggest thing. And I try to own events when I can get them, and I try to sell premium between events. But sometimes you just get stuff that just catches you out from the side. It had nothing really to do with it. Yellen making comments about stuff will tend to move things. And maybe it was foolish to get out of it because now that news has come out, they're probably going to quiet down. Sometimes I don't time things so great either. Let's see here. How important is it to learn all of the options strategies to become a successful options trader? Which top 5 would you suggest someone master first? All the option strategies? There's an infinite number of option strategies. It's not necessary to master some specific structure. We often, in a forum like this, it's common for us to do things like talk about structures that people are familiar with, like straddles or strangles or call spreads and put spreads and butterflies and condors or whatever. The truth is that options traders who came from my background, who traded volatility, we never thought about trading options that way because we were just making markets. People would trade options and we would try to take the other side. We would try to sell vol when we thought it was overpriced, and we would try to buy vol when we thought it was underpriced. And when and where we could, we would just try to spread it out across the book. So that was just opportunistic. We didn't think about a specific strategy. You don't need to master or understand a strategy. You need to master and understand how options behave and the things that affect their value. So what are the things that affect their value? Well, there's just a handful of big things. The price of the underlying stock. That's delta. When the stock goes up, does the value of my options position rise or fall? At the simplest level, if you're just talking about a call or a put, an at-the-money call or a put, if the stock goes up, the call will go up and the put will go down, and vice versa. And how much they will rise or fall instantaneously is their delta. So that's the first thing you got to worry about. Understand that. And actually, if you get that, if you really knew which way a stock was going, you could trade the stock profitably or options profitably, even if you didn't really understand anything else. Unfortunately, most of us don't have a crystal ball or access to some really good information that gives us huge insight onto how a stock is going to trade immediately. So instead, we try to make calculated bets on that. Okay. What else affects the value of an option? Well, the passage of time, of course. The longer an option has until it expires, the less the passage of one day to another is going to make a difference. But options decay. If they have value beyond their intrinsic value, that is how much they're in the money, they're going to decay a little bit each day. And as expiration approaches, the rate of acceleration increases up until the option becomes so, relatively cheap compared to the stock that there isn't much left to decay. So that is an important concept to understand. Implied volatility, which is how much the market expects the underlying stock to move around and reflects that into the price of an option. If that volatility increases, then the options premium that's basically, there are two ways to refer to the same thing. So just understand that. If the perception of future volatility rises, all else equal, the value of options will go up rather than down. This is what I'm about to talk about now, which is just how options price throughout sort of the term structure, which is how long it is till they expire. In a normal market condition, the implied volatility of an option that is farther out in time is higher than it is lower. And where you will see exceptions to that rule are in and around what we were just talking about, events like earnings, investor days, economic releases, things like that. Options will be more expensive around those. They should be more expensive because that's when things move. And once those events come and go, options premiums will fall. Some refer to that as vol crush. But really, we're just talking about an event variance or an event volatility being priced into an option and then not being priced in. So one day you have it, one day you don't. So the ticket's no longer good after the event's already come and gone. So that's, just a torn ticket stub at that point. So you don't need to know every options trade. You don't need to know what a jade lizard is or Christmas tree or, pick any convoluted options structure you can name, and some will name them different things. It doesn't really matter. What you just need to understand is what affects the value of an option, and that is the perception of volatility, the price of the underlying, the passage of time. Those are the big ones. Less important usually, but can have a role, are things that also affect the value of a stock, which are interest rates and the dividends that the underlying stock pays. Those things also have an impact, but they also impact the value of stocks. They impact the value of risk assets generally. So you don't need to master them. And start with something simple. Start by just trading calls or puts, sell calls against stocks you own, and just observe how they behave. And you're going to be well on your way to understanding it. It's actually interesting. My second options trading job. So I started off on the Philadelphia Stock Exchange. I was also a member of the American Stock Exchange. I traded for a company that was sold to Knight Capital Group. Knight Capital Group went completely sideways. For those who are familiar, that company ended up blowing up because of some mistakes that were made on the tech side. But when I went to talk to the principal of the new firm that I went to, a company that still exists called Bluefin Trading, it was founded by a guy named Mike Goodwin, who was a former Susquehanna trader who worked for Jeff Yaz. The question he asked me was, how did you learn to trade options? And I thought he was asking me a professional history question. I said, well, I started at a proprietary trading firm. They had a trading class. I went through that trading class training, tests, worked as a trading assistant, the normal sort of course of things. And then I realized that was not his question at all. He really already had the pre-baked answer. And the answer is by doing it. And that's true. You learn more about how options behave by trading them than any class will ever teach you. It's the best classroom there is. Unfortunately, the tuition can be high, so keep it small. Here's an interesting one, too. They're all interesting questions, but is there any viability in using unusual activity in options? Have those moves typically been made in the options premium? They've made the unusual list. Is there best practice search criteria? I do care about unusual volume. I am definitely interested in that. One of the reasons I'm interested is because, and here I'm actually looking at some names that have unusual volume. Let's see, is there a way I can blow this up? I don't know. I think this is pretty, so unusual call volume. So here I'm looking for, in this case, I'm just looking at U.S. companies that typically trade at least 10,000 contracts a day that have traded at least that money, and then ranking them by unusual volume. And we see a couple names in here. Some of them are not that surprising. DJT, which is the now well-known, basically meme stock, which is Trump's Truth Social. That is obviously traded a lot. Stock was down a lot today. Very hard, almost impossible to borrow stock. So there's a lot going on there. Not, I like to look at this just to see what stocks are moving, and you'll often see that that's the case. So Bausch Health, you can see the stock was down 7% today, traded unusual call volume. Now this one, of course, Paramount Global, has been, a lot of people have been looking at it because it's a deal name. Obviously, it's not trading like it's going to happen, and there's a lot of options activity. So I will definitely look at unusual volume for those reasons. There's another reason too, which is that when there's a lot of unusual volume, sometimes it could be because some institutional market participants believe that an upcoming event is going to be more important than maybe it might otherwise be. And so I'm very interested to see what's going on there and see whether people are buying a lot of premium into these things or selling it. Because one of the biggest things I look at is event variance, how much the options market is implying that an underlying asset can move going into an event. In fact, I often look at the term structure just to see whether the event's going to take place when people say it's going to. I assume that there are a lot of savvy options traders. There are people with more information than I have. And if they have that information and they're trying to take advantage of it, it's going to be reflected in options prices. So I care a lot about that. And the other thing is that, somebody had asked in an earlier live stream how important open interest is. It's important to me in one sense also, which is that the more options trade in a name and the more open interest there is, if we just think about the wisdom of crowds, right? So there is a phenomena whereby you can take a large sample of people and you can ask them things. And very often, the information that a large crowd will provide about some unknown is better than the best guess of a small sample of experts. And basically, there's going to be a lot of ludicrous guesses in a huge group of people. But on the whole, the information that they give is really quite good. So what that tells us is that the more open interest there is, the more trading volume there is, essentially the more people are betting their own capital with whatever intelligence they have, or lack of intelligence they have. So we want that sample to be big. To the extent that we think we can extract useful information from the sentiment of all active market participants who are committing capital, we want the sample to be as large as possible. So I do care about the volume, and I do care about the open interest for those reasons. I think producer Jay just said something to me, and I just looked at the clock. Yes, I just looked at the clock and realized that I have once again chewed up astonishingly much more time than I meant to, because I don't mean to keep you guys around so long. And for those of you who stuck around for as long as you did, that is really remarkable patience that you have. So my long-winded diatribes have come to an end on this Monday afternoon, but I can bore you to tears again on Wednesday if you want. Like, subscribe, and tune in at 4:15 then if you want to hear more of this kind of stuff. Really appreciate your time.